Okay, so there's a huge warning signal flashing right now, but it's not where you'd expect. Not in stocks, not in crypto. Today, we're looking at a source that says the real story is in the often overlooked silver market. It's claiming this is the epicenter of a hidden crisis, one that's unfolding far from the headlines, but could have massive implications for the whole financial system. So here's the paradox our source points out. On one side, you've got this historic flood of retail money, your average investor, just piling into a handful of popular tech stocks. But on the other side, the institutional players, the so-called smart money, are apparently making a very, very different bet. They're quietly accumulating physical silver. And that brings us to the big question, right? The mystery at the heart of all this. If there's so much institutional buying and a potential supply crunch, why isn't the price of silver just exploding? The market seems calm, almost too calm. So let's follow the clues laid out in our source and see if we can understand this paradox.
All right, let's dive in. Our first clue takes us right inside the COMEX, one of the most important metals exchanges in the world. You can think of it as the place where the price of silver is basically set. But what our source indicates is that the real story isn't the price you see on the screen. It's what's happening behind the scenes with the delivery mechanics.
As of late February, the source flags this number, 294 million ounces. Now, what is that? That's the amount of silver represented by paper contracts, what's known as open interest, that could theoretically demand delivery of the real metal, and that's just for the March contract alone. But, and this is where it gets really, really interesting, of all the silver that's held in the COMEX vaults, only 90 million ounces are actually registered, which means that's the only silver officially available for delivery against all those paper contracts. And this chart just lays it out perfectly, doesn't it? On the left, you've got this mountain of paper claims, and on the right, the much smaller pile of physical supply. We're talking more than 3 ounces in paper claims for every 1 ounce of actual physical silver ready to go. The implication here, if even a small fraction of those paper holders decided, you know what, I want the metal, it would create a serious drain on what's available. This quote from the source material just perfectly captures that hidden tension. The price might look stable, but underneath the surface, this paper market is stretched thin over the physical reality. It's a pretty fragile situation. Okay, so we've got a disconnect in the paper market. That's one thing, but that's only half the story. Our second clue follows where the actual physical silver is going, because believe me, it is on the move. The source points to this consistent and pretty significant price difference. Over in Shanghai, physical silver has been trading at a premium of around $10 an ounce over the Western price. This creates a powerful financial incentive, an arbitrage, to buy metal cheap in places like New York or London and sell it for a nice profit in China. And you gotta understand, this isn't just numbers on a screen. It has a real-world consequence. This price gap is literally acting like a giant vacuum, physically pulling silver out of Western exchanges and shipping it to the East, where it's being valued much more highly. And like the source says, this is just the logical outcome. Capital, and in this case physical metal, it flows where it's treated best. As long as this price gap exists, the drain from west to east is just going to continue. So this brings us to a key question. Who is behind this massive, steady demand for physical metal in the East? The source identifies a very specific group of players who are taking delivery. Yeah, the reporting suggests it's not small-time speculators. It's central banks from emerging economies in the global south, it's billionaire investors, and it's major hedge fund managers. These are the big fish who are systematically taking possession of the real metal month after month. And their method? It's described as slow and insidious. By buying consistently over time instead of all at once, they drain the exchanges without causing a sudden price panic that would actually work against them. It's a strategy of attrition. You know, this isn't happening in a vacuum. The source connects this activity to a much broader trend, citing figures like hedge fund manager David Einhorn. He argues that we're seeing a growing loss of confidence in traditional paper assets like government bonds and a return to hard assets like precious metals as the ultimate reserves.
So let's connect these clues. We have the paper imbalance on the COMEX, the physical drain to the east, and we know the identity of the buyers. So what is the final conclusion the source draws from all this evidence? What does it all mean?
Well, the source offers this powerful metaphor. Silver is the canary in the coal mine. The idea is that the stress showing up in this pretty niche market isn't just about silver. It's an early warning signal for a much wider fragility in the entire global financial system.
So here's the final argument, boiled down. The paper markets we all watch are built on credit, not on metal. The real physical demand is showing up loud and clear in the East. And because of that, true price discovery is shifting away from New York and London. And ultimately, this isn't just a commodity story. It's a signal of a fundamental shift in confidence away from the current financial system.
And all this leads to a final, provocative question that really gets to the heart of this entire warning. It encapsulates the core tension between a financial system based on paper promises and the finite reality of the physical world. So, what happens when those two things can no longer be reconciled?